going and buying a long-term rental wasn't going to help me in the tax world that I was in. I needed to go invest in a short-term rental. And so I was strategic about my investments. I was either going to pay the government $80,000 or go put that $80,000 down on an investment property. And so I was able to work it to where I was able to put that down on an investment property and save about $60,000 in taxes, which almost covered my down payment. But I would have never known that had I not gone to conferences, had I not learned about the short-term rental loophole.
Hello, everyone, and welcome to the Journey to Multifamily Millions. I'm your host, founder and CEO of Zana Investments, Tim Little, and today's show we have with us Erik Oliver. Erik is a vice president with Cost Segregation Authority, and he is passionate about identifying cost savings and educating commercial real estate owners on the benefits of cost segregation. Erik, welcome to the show.
Thanks for having me. I'm glad to be here.
And it is great to have you. I know everybody wants to hear about cost segregation and what it is and how it can save them money. But before we dive into all of that, please tell us more about your background and how you got started on your real estate journey.
Yeah, no, those are good questions. So I'll start with my background first. So born and raised in Salt Lake City, Utah, went to school here, looking to get out of college as quickly as possible. Didn't know what I wanted to do with my life. Ended up with an accounting degree of all degrees, simply because math always came easy to me and I hated writing papers and didn't do well in science. So I'm like, how do I get out of this place as quickly as possible? And so it was an accounting degree. Never had any ambition of becoming a CPA. Never really used my accounting degree. Once I got out of college, ended up in some business development positions that took me around the country, sales type jobs. Ended up in Richmond, Virginia for 12 years, and then Long Island, New York for 5. And then I decided to move back to Utah. I had some aging parents and had kids by that time, was married, wanted to get back to Utah, and came across this job, not knowing what cost segregation was. All I knew is it had to do with real estate, it had to do with accounting. And I'm like, those are two things that I'm very interested in. And so ended up here at Cost Seg Authority. As far as my investing journey goes, my first investment property was by chance. It was when we were moving from Richmond, Virginia to New York. We decided to keep our primary residence that we had in Richmond when we moved up to New York. Do I dare say it was an absolute nightmare, my first rental property. My wife and I are fairly frugal, and we were like, we're not going to pay a management company. We got this. We know what we're doing. I read enough books. I can figure this out.
Sure.
And needless to say, it was an absolute disaster. So we moved up to New York. We had some tenants in there, didn't run background checks, didn't run credit checks. Seemed like nice people at the time. They paid their rent for the first 3 months, and then they started getting garnished from their prior rental property that they didn't pay rent on. So once they started getting their checks garnished, of course they couldn't pay me. Anyways, long story short, finally got them out through a long court process of trying to do that by myself from New York while these guys were living in Virginia. We were able to get them out of there. Actually, about 7 years after that experience, I got the check in the mail from them finally got paid from those guys. But I learned a lot on that first rental property. Then when we moved to Salt Lake, we actually sold that property in Virginia and bought our home here. We switched homes, kept that rental property, our first home here in Salt Lake. We kept that as a rental property. By that time, I was into the cost seg business, learning more and more about real estate, attending conferences. It's one of the great benefits of my job is going out and presenting cost segregation at different conferences across the country. I also get to attend these conferences, so get to meet a lot of great people, learn a lot of great information. And since then, we've got 2 long-term rentals, a short-term rental, and then we're a passive investor in some micro apartments here just north of Salt Lake. And so that's what got me started on this investment journey.
Yeah, that's awesome. And I want to hit a couple of the things you talked about because it sounds like you and I were opposites. I liked writing and was fairly good at it, and math did not come naturally to me. So it took a decade or so in the real world before I actually even thought about getting a business degree when I got my MBA, because I was very intimidated because I knew they'd make me take math. That wasn't negotiable. So yeah, I've had to take a few accounting classes. I wouldn't say it went well, but it didn't go disastrously either. I managed to pass, and that's what matters in the end, right? And then you talked about what we call being an accidental landlord almost, right? Using that, what was your primary residence and turning that into an investment property, which It's the challenge with that is you didn't come into it as an investment. So
Right.
it's not like you ran the numbers on it when you were buying it as an investment. That was the place you wanted to live in, right? Is it right for you? Is it right for your family? You weren't thinking about how much free cash flow you would get at the end of the month. And sometimes it works out great, but other times, we learned some lessons from that. And it sounded like you learned some of the same lessons that I did. I did my primary residence in Colorado Springs. I had to rent it out because didn't want to sell it at the time. And this was, around the 2008 time frame. So you can imagine how that went. Luckily, I wound up breaking even on it, but that was about the best I could hope for during that time frame. And we had decent renters, so it wasn't too bad. But I wasn't nearly as ambitious as you at that time to try to self-manage.
Right.
So so I was willing to shell out that 10%, mostly because I wasn't local enough to deal with anything. And then you talked Richmond, which is actually where my first investment property was. I bought a little duplex in North Richmond, bit of a rough neighborhood, lower income. It wasn't like it was super high crime or anything, but I inherited a renter, and I was like, having a renter is better than not having a renter, right? Depends who your renters are. And
Right.
like you, it's like I discovered very quickly they paid for 2 months, and then all of a sudden the payment stopped. And as soon as I started knocking to say, where's the money, they just disappeared one night. Like, just left everything there and were just gone. So then you have to pay like thousands of dollars to have their stuff removed, then get it rent ready. Like all these things that I hadn't even thought about beforehand. You learn those valuable lessons early and often, unfortunately. But Richmond wound up being pretty good to me from an appreciation perspective.
Yeah.
Um, so I can't complain in the long run. But, and then the other thing that I wanted to bring up that you learn a lot at conferences, and we see this a lot, right? Like it's not just real estate aficionados going to real estate conferences. It's those people who are enablers to people in real estate who maybe they're accountants or CPAs or lawyers or cost segregation folks, and they're going to teach us stuff at these, but you're getting to sit in those seats too and learn all this stuff. So I think it's a great environment, one, to meet people, which is, I'm sure, one of the reasons you're going
Yeah.
there, as well as educate. But two, you're able to like siphon off the knowledge and start your own real estate investing journey, which maybe wasn't even your plan at the time until you got into that world. Maybe you can tell me a little more about that.
Yeah, no, I think you hit it on the head. It definitely was not part of the plan. You mentioned accidental landlord. The first investment property I have was just that. It was an accidental landlord. We were moving into a place where we were renting. We didn't need to sell our home at the time because we weren't buying another home. So, okay, let's do the appreciation play on this. This thing's going to go up in value over the next couple of years. We actually, like you said, we didn't go into it as an investment property. So we weren't really cash flowing. We were making a couple $100s each month that covered some of the repairs that needed to be done, but it wasn't really for the cash flow. It was more or less we needed to get to New York. We didn't have time to sell it. Hey, why not rent it out and we'll sell it in a few years? And we ended up owning it for renting it for about 5 years before we moved back to Salt Lake. But it was definitely by accident that I got into this business. When I came on to Cosseg, that was my only rental experience. And then as I got into this world of real estate, I've always been somewhat interested in it, but I've always had my degree was in accounting. I was always in a business development sales role with my jobs, 401k, I don't know. My dad raised me to be real super conservative. I blame it on my dad. He was a police officer and blame it on him. He never wanted to take risks, but always just did the 401k thing. I said, I'm going to have a little bit of money when I retire. If I can just keep building this 401k. And then so I started getting into this cost seg world and working with these investors. I'm like, damn, what am I doing? Like I should have started this real estate thing a long time ago. And I kick myself that I didn't start it when I was a lot younger because I do think there's so much value and so much opportunity to create it's not just about the money and it's not just about, but long-term flexibility, the ability to, my ultimate goal is obviously to have enough passive income that I can retire at a fairly early age. When I was in sales, uh, working for other companies, my goal was just to retire at 65, 70 and do that thing. Now my goal is to retire at 50, 55. I want to be able to enjoy retirement. And so hopefully by investing in some of these properties, one, I've been able to learn a lot about tax that I didn't know before. And we can get into that here in a second. But part of the reason I own a short term rental is simply for the tax play. I had a tax liability that I was going to have to pay. And I said, I don't want to pay that. But I'm a W 2 employee. And so I knew that going and buying a long term rental wasn't going to help me in the tax world that I was in. I needed to go invest in a short term rental. And so I was strategic about my investments. So I was either going to pay the government 80,000 or go put that 80,000 down on an investment property. And so I was able to work it to where I was able to put that down on investment property and save about $60,000 in taxes, which almost covered my down payment. But I would have never known that had I not gone to conferences, had I not learned about the short-term rental loophole, had I not been in this cost segregation business. So I lucked into it. I don't want to say, I guess it is luck. I lucked into my real estate investment career because that's the short-term rental side. And then I mentioned the micro apartments. That was something that we actually found out here doing cost seg. So we got called to do a cost seg study on some micro apartments up in Seattle. I say we, it was my boss at the time, the founder of our company. And he thought, wow, what a great idea. We could use these micro apartments here in Salt Lake Valley. And so they've done 3 or 4 different projects in opportunity zones where they've bought the land. They've been able to develop these micro apartments. They're anywhere from 400 to 600 square feet. Usually the rent is fairly low compared to what it is in the market because they are small. We put them by train stations, track stations, so that we haven't had to have any parking. It's great for students. It's great for people who work downtown, who just want to be downtown. They don't need to have access to a car. Anyways, it's turned out great in being able to learn about opportunity zones. I would have never known about opportunity zones had I not come across this job. And so that's another way to build some long-term wealth. And so it's been a great career. I've loved every minute of it. The cost seg side of what I do day to day, I love that. But I think more so I've loved being able to educate myself on one, taxes, which is a big thing where I think a lot of people don't know that much about, and they just put that in the trust of their CPA or tax preparer. And I think sometimes that can be a problem if they aren't real estate focused or real estate driven. Sometimes we're leaving a lot of money on the table. And so I've been able to learn a lot about taxes and then also just, a lot about real estate and investing in general. So it's been a great ride so far and look forward to continuing down that path.
Yeah, that's awesome. It sounds like you've been able to learn a lot about a lot of different types of assets and investments. All right, so let's switch over to the cost segregation piece because I know some people listening are probably very familiar with it if they're relatively active. They're owners of apartment buildings, stuff like that. But for the folks who may be new to it, please just explain what a cost segregation analysis is and generally how it can save you money / taxes, however you want to look at it.
Sure. Yeah, no, great question. So cost segregation really is just accelerated depreciation on your real estate investments. So for those of you that don't know what depreciation is, the government allows us to take a depreciation expense every year on our investment properties. Normally that depreciation expense is spread out over either 27 and a half years for residential units or 39 years for commercial units. So to make the math easy, let's say I buy a $275,000 single family home. Essentially, I take that 275, divide it by 27 and a half years. I'm going to get a $10,000 write-off every year against my income. So it's a $10,000 non-cash write-off against my income. That's called straight line depreciation. I probably oversimplified that a little bit. Land is non-depreciable, but just to make the math easy, you always have to back out the land value. So remember that land is non-depreciable. But the idea is just you get this deduction. The government says, hey, that piece of property, that building is deteriorating over time. And so we're going to let you expense that over time. A lot of us don't own our properties for 27 and a half years or 39 years for commercial properties. And so the idea behind cost segregation is how can we accelerate or take that deduction at a much faster rate? There's a time value of money element. There's an inflation element where $1 today is worth way more than $1 39 years from now. So give me my deductions today versus letting the IRS hold on to those. the way we can do that is through an engineering-based study where we go in and let's say you buy a single-family rental for $275,000. When you buy that property, you're buying more than just the land and the walls. You're also buying some appliances that are in that property. You're buying some carpet. You're buying a ceiling fan or two. You're buying some cabinets or shelving or countertops. All those things I mentioned should be, according to the IRS, depreciated at a much faster rate, which makes sense. Carpet doesn't last 27 and a half years. Right. So when you actually go read the tax code says carpet should be depreciated over 5 years. Now, the problem is that most tax preparers, they don't know that you have carpet in your building, let alone how much, let alone what the value of that carpet is the time you buy it. You hand them a closing statement that says, hey, tax preparer, I bought this long-term rental for $275. What typically happens is they take that, they put it on the books as a 27 and a half year asset, and you get your 1/27th of a deduction. A cost-saving study comes in, instead of putting one line item that says building on the depreciation schedule, you're now going to have a line item that says flooring, cabinets, countertops, appliances, trees, bushes, and shrubs, landscaping, land improvements. And by doing that and depreciating the value of your carpet, let's say that we determined the carpet was valued at $15,000 worth of carpet in your rental property. That $15,000 now gets depreciated over 5 years versus 27 and a half years. So you're getting a much larger deduction up front, which allows you to take advantage of that and create cash flow up front. So we're getting our tax savings now versus in the future. And so that's really what cost segregation is. It's just accelerated depreciation on your real estate assets.
Yeah, and the way I like to think about it, it's really breaking up a property down to its components. Like we don't have most of us don't have the time, expertise, or energy or desire for that matter, to go down on a spreadsheet and break down everything that's in a property, especially once you get into the larger properties. And so I think that's the value that a cost segregation analysis person brings to the table, right? They're doing these things that you wouldn't otherwise be able to do, which is to accelerate it. Because otherwise you're stuck, like you said, with that baseline depreciation that the IRS tells you can go with. And that's the path of least resistance for most people. So they're like, okay. Same things for the CPAs. They don't know any better. And they're probably not going to ask because, again, this is somewhat specialized and they may not have the resources or know-how to do that themselves. So they might just tell you to go find someone else to conduct that analysis and then apply it to your taxes. They'll be happy to do that. Most of them won't know how to do it themselves.
No, you hit it on the head. This is a specialized service. And it's interesting that the audit guide, so the IRS puts out an audit guide for their agents on how to audit these cost seg studies. And in that audit guide, it specifically states that you don't have to have any type of credential to do cost segregation. So a CPA could essentially do it. However, it does state specifically that you've got to have an experience and expertise in both tax law, so taxes, as well as construction. And so it's very rare that you find a CPA / tax preparer who has a construction background or a constructional engineering background to be able to break these building apart. Because, and I've seen CPAs try, and I'll give you an example. We've got a CPA who called me who said, I inherited a client and the old CPA did a casual cost segregation study. And I'm like, John, I don't know what the hell you're talking about. What's a casual cost segregation study? And he goes, here, let me send you the depreciation schedule, Eric, and I think it'll make sense. So I got the depreciation schedule. And on the depreciation schedule, I think, if I'm not mistaken, it was either an 8-plex or a 16-plex. I can't remember. But I had the line item that said building. And then there was 3 line items underneath that. One said parking lot, $80,000, appliances, $75,000, and flooring, $12,000. So what the tax preparer did, the CPA was like, hey, my client needs some additional deduction. I know there's a parking lot. I'm going to pull a number out of that $1 million purchase price and apply it to the parking lot so that my client gets an extra deduction. So they thought they were doing their client a favor by breaking these 3 pieces out and creating these extra deductions. what they were actually doing was leaving money on the tax table, one, and creating a possible liability, two. So we
Red
ended
flag.
up doing the cut. Yeah, red flag. First thing is don't use whole numbers. If you're going to say the parking lot's worth 80,000, say it's worth $81,472 because 80,000 would be a red flag if I was an agent. But
Right.
what they did is a tax preparer, as a CPA or a tax preparer, they don't know if that asphalt in the parking lot is 4-inch asphalt, 6-inch asphalt, and there's a very big difference in cost for that. Long story short, when we looked at the numbers, they only segregated a small percentage of the total that could be segregated. We actually ended up doing a cost seg study, and we found out that the parking lot was not worth, in fact, 80,000, but it was worth 120,000. And so that, what is that, a $60,000 difference just on the parking lot, $60,000 of additional depreciation. If you're in a 30% tax bracket, that was $18,000 of tax savings left on the table. And so, again, you don't have to have any kind of credential. There's no certification that we go through. There's no governing body, but you do have to have the experience. And so, in that instance, we were able to create a significantly larger tax savings by doing the study. Now, it cost the client a couple $1,000s for us to do the study, but if we're able to create an extra $200,000 of depreciation, again, if you're in a 30% tax bracket, $200,000, that's a $60,000 tax savings, additional tax savings. Yeah, you don't have to have any specialty credentials. There are none, but you do have to have some knowledge of construction because it's not just, and I'll elaborate a little, it's not just going in and counting the appliances. So sometimes CPAs will say, I know that's a washer and a dryer. They're about $500 a piece. So I'm going to put on the depreciation schedule $1,000 for appliances. That's good. That's better than putting nothing on the depreciation schedule for the appliances. But when we go in and do our engineering-based study, we actually get to take not just the washer and dryer, we get to take the electrical that goes to the washer and dryer and put a value to that plug because you've got a special plug in your laundry room for your dryer. The only reason that plug is there is specific to that dryer. So the IRS says, hey, that electrical component is part of that dryer. And so we'll put a value to the electrical work all the way back to the circuit breaker and say, okay, the dryer was 500. The electrical work for that dryer was another 300. And then the plumbing for the washer, because you've got to have the drain for the washer, that was another $600 worth of plumbing. And so now we've just created a much larger deduction than just taking the washer and dryer. We get to take all the different components that go with those washers and dryers. And when you think about multifamily specifically, how much of the electrical work that goes into a multifamily building is specific for short-term assets? Washers, dryers, range hoods, garbage disposal, ceiling fans. Sometimes it can be as much as 50% of the electrical work going into a multifamily building is specific for short-term assets. And so we get to put a value to that electrical work and say, okay, let's depreciate that portion of the electrical work over 5 years versus 27 and a half. So it is a very specialized kind of niche accounting service that we offer. And that's why most tax preparers don't offer it because one, they don't know how to do it. Two, they don't want to take on the liability. And so they'll usually outsource that work to a firm like ours because we've got that expertise.
Yeah, and that all makes sense. And you alluded to this a little bit when you started talking about, say, you're paying a couple of $1,000s for the service, but you wind up saving this much on the tax side. Talk a little bit more about when this service makes sense for someone, just from that cost benefit analysis, right? Because it's not going to make sense for everyone. If I have a $100,000 single family home, I'm going to assume it won't make sense, but you can correct me if I'm wrong. But that's a hugely different scenario than someone who has like that 16 unit apartment building. Talk a little bit about when it makes sense and what the, I don't know, I guess pricing is for the services.
Yeah, no, that's a great question. And that is it's a tough question to answer because there are a lot of variables depending on your tax rate, depending on how long you've owned it, what the tax law was when you first bought it and put it into service. But a general rule of thumb, if your building's what we call depreciable basis. So depreciable basis is your purchase price minus the land value. That gives you your depreciable basis. If that depreciable basis is above $200,000, it's probably worth having a Class A company run some initial numbers. Now, doesn't always mean it's going to make sense. It depends on what your tax bracket is, depends on how long you've owned it. So if I bought a $200,000 home back in 1985, and I've been depreciating it since 1985. That building is fully depreciated and there's no value in doing a cost seg. Now, same scenario, let's say I bought a $200,000 home in 2020 when there was something called bonus depreciation of 100%. That $200,000 single family home could create anywhere from a $50,000 to $60,000 deduction. So a $60,000 deduction, if I can reduce my taxable income by $60,000 and I'm in a 35% tax bracket, those are hard numbers to do in my head. That is about a $20,000 tax savings, give or take. Don't quote me exactly on that, but it's about a $20,000 tax savings. So if I have to pay $3,000 to have a study done, but I get a $20,000 tax savings, that might make sense. And so I would say anything around $200,000 is worth looking at. The fees on these studies, they've come down significantly. So there was something, we should probably jump into it now. I imagine now is as good as any, but there's something called bonus depreciation, which kind of changed the landscape for cost segregation. Prior to the Tax Cuts and Jobs Act, that was the tax overhaul that was instituted by Donald Trump back in 2017. So prior to that, bonus depreciation was at 50%. And let me explain what bonus depreciation is. Bonus depreciation is a tool the government uses to stimulate the economy. So if the economy's not doing well, they'll say, hey, we're going to increase bonus percentages to 80%. If the economy's doing well, they'll say, hey, we'll decrease it to 20%. But basically, it's incentive for you to go out and buy stuff. And interestingly enough, I don't know that it was ever thought of as being used in terms of real estate, because when they created the bonus laws, they said bonus depreciation only applies to assets that have a useful life of 20 years or less. So remember, real estate has a useful life of 27 and a half or 39. And so I don't think that they even applied it to real estate for a number of years. And then there was some sophisticated CPAs who said, wait, what if I break my 27 and a half year building down into these smaller pieces? We've got a bunch of carpet in there. We know carpet's a 5-year asset. Therefore, now we can apply that bonus. So bonus depreciation has been around a number of years. The 2017 Tax Cuts and Jobs Act put it on steroids, and they came up, the two things changed. One is bonus went from 50% at the time to 100%. So any assets placed into service between 9/27 of 17 and 12/31 of 2022 were all eligible for 100% bonus, which was huge. That was the first big change. The second change, which I think was more important, I actually think a lot of the Congress folks didn't even realize what they were voting for when they instituted this, but they added 5 words to the tax code that made all the difference in the world. They added the words "new to you, the taxpayer." So prior to that, bonus only applied to brand new products. I had to go buy a brand new bulldozer. I had to go buy a brand new work truck. I couldn't buy a used work truck. It had to be brand new right off the assembly line. Yep. When they added those words, "new to you, the taxpayer," and when you apply that to real estate, all of a sudden, I don't have to go build a brand new multifamily building. I can go buy an existing multifamily building that was built in 1980. It's new to me, the taxpayer, and all of a sudden, I get 100% bonus depreciation on the assets that have a useful life of 20 years or less. So this was the best news in the world as a cost seg provider is, hey, we've got this bonus depreciation, but it only applies to assets that are 5, 7, or 15 years. Because now when you buy that multifamily, Tim, that's a 30 or 27 and a half year asset, but you want to apply bonus, you've got to call us to come in and say, okay, of that 27-year asset, what of that stuff is 5, 7, or 15? And so it was a great bonus depreciation has been great for the cost seg industry because you basically have to pay for a cost seg study in order to utilize bonus because, again, bonus can't be used on a 27 and a half year asset. So the reason I'm telling you all this about bonus, going back to your original question, is when they passed these bonus laws, it made cost segregation applicable to a lot smaller investor. Prior to 2017, you had to have about $1 million property in order for it to make sense because the benefit was lower because there was no bonus. There was bonus, but it was a lot smaller and it was only for new construction. So the bonus amounts were smaller and the fees were significantly higher. When they passed the tax law, cost segregation became more and more prevalent. There was more and more competition within our industry. So the fees came down, yet the benefit was going up significantly because of these bonus depreciation amounts. And because of that, it now made sense on a $200,000 single family rental. Because again, if I can save $25,000 in taxes and it's only going to cost me $3,000 to do it, I'll take that all day long. And I would say anything north of 200,000 is worth looking at. Again, it doesn't always make sense. There's other factors you need to consider, like passive versus active income. So you want to talk to your tax preparer about that. But anything with a depreciable basis of 200,000 is worth looking at.
Yeah, and I think that's very helpful to think about, because there's all these different scenarios where it may or may not make sense. And I think one of the things that we get caught in is almost overselling. And I say we, not you, like I say we as operators who are raising money for these deals. Sometimes folks get a little too overzealous in talking about bonus depreciation and the benefit it can bring, because I want people to understand that, hey, they might be thinking as they're listening to this, yeah, that's great for some millionaire who's buying a big apartment building or something. But this also is applicable to those who are passively investing in these syndication deals. Because what we do as the operators is we say, hey, we're getting all this awesome depreciation, bonus depreciation, but we're passing it down to the passive investors because you guys are the ones who gave us the money to buy this deal. So that's the benefit gained from the passive investor perspective. And what that looks like is they'll receive a K1, which says, hey, you didn't actually make any money on this deal. You actually, lost $10,000. And did they lose $10,000? No, it's a paper loss, right?
Yep.
Because of that depreciation that we got and then passed down to them. So they may have gotten a lot more depreciation than they actually did distributions from that deal. So this is where we get into it may or may not benefit them. If they have other investments that had taxable events, say one of their investments just went full cycle and they got a lump sum of $100,000 in profit from that deal, they have a lot that they need to try to bump down from a taxable income basis. So that's where this can really be helpful. Otherwise, it just certainly doesn't hurt, but they may just start like banking up this depreciation, and that does roll over. So talk to your tax professional. I'm not a tax professional in any way, but that does roll over. So maybe you could use it next year when you have a big taxable event or something. But this is where, I always encourage people to have a tax strategy, not just do their taxes. Especially if you have multiple and complicated investments, you can get very strategic in the timing of these things in order to offset them, right? If I know a deal is coming full cycle next year, then maybe that's a good time to invest in a new deal, get that huge depreciation in that first year, and then they cancel each other out. All of a sudden, I'm getting basically tax-free profit from some of my deals. So I just want to give people an idea that this is not just for those who own the properties, but there are also benefits for those passive investors as well.
Yeah, no, that's a great point. And just to add to that, in that example where you might be going full cycle on a property, you're going to sell a property, you may not even have to go buy a property. You may just have properties in your portfolio where you've never done cost seg. So the IRS actually allows us to go back and look at properties that have already been placed in service. So let's say I sell one of my buildings this year and I've got a large capital gain of it, but I've got these other buildings in my portfolio where I never did cost segregation. I can go back and do cost segregation on those buildings, take all that missed appreciation that I should have been taking over these years, bring it all forward, drop it on my current tax return without having to amend. There's an additional tax form that's required. It's a 3115, but it basically tells the IRS, hey, I've been depreciating these older assets using my standard 1/27th of a deduction. I now want to accelerate or front load those, and I get to drop all that on my current tax return, which then in turn knocks down or offsets that capital gain event, and I basically pay no tax. And so cost segregation, and you touched on something, and I'll reiterate this because I think this is the most important thing that I've heard or that I hear or that I like to share with people is there's a huge difference between a tax preparer and a tax strategist. A tax preparer is the H&R Block within the Walmart lobbies where you go in there, They take a stack of papers, they process it through their system, and it spits out and tells you how much you owe. And they actually get paid on how many of those they can process on a daily basis. A tax strategist will stop and sit down, and they should be meeting with you multiple times throughout the year to say, hey, what are you buying? What are you selling? What are your expenses looking like? What are your tax liabilities looking like? Because sometimes you can't do that when you go meet with them April 15th or April 14th because the year is gone. And so you've got to have a tax strategy, especially as you guys start to build your real estate portfolios. Tax strategists, they cost a lot more money than a tax preparer, but they are worth their money tenfold oftentimes. A good tax strategist, you might pay him $5,000 to do your return, but they're going to be able to strategize and find these cost segregation. They're going to find additional deductions, tax credits, tax deductions in one form or another where they can reduce your tax liability. The way you set up your entities makes a huge difference on how they're taxed. And so having a tax strategist who, one, understands real estate is very important. Don't go cheap in the tax preparation, tax strategy department. Always find somebody who understands real estate, who's going to work with you, not just process your return, spit out a number and tell you, here's what you owe. Because it could save. I see it all the time where we meet with people and they're like, okay, I've got all these properties. I just heard about cost seg. What do you think you can do? And we give them numbers and they're like, wait, last year I wrote a check for $200,000 to the IRS. Are you telling me I could have done this last year? And it's a rough talk to have with their CPA. We try to always talk up the CPA because CPAs don't specialize in this. It's like going to your general practitioner to get brain surgery. You wouldn't do that. And then it's not their fault that they don't know how to do brain surgery. It's just not what they specialize in. Your typical tax preparer, CPA, they are like your general practitioner. They know a little bit about a lot of subjects. But once you start to build that portfolio of real estate, it's usually time at that point to find yourself somebody who specializes in real estate, who's going to strategize with you, because if not, you could be leaving tens, if not hundreds of thousands of dollars of tax savings on the table.
Yeah, I couldn't agree more. That tax strategist is worth their weight in gold.
Yeah.
All right, we're running short on time, so we are going to transition to the turbo round. I'm going to ask you 3 questions that I ask every guest, and I just ask for a quick, honest answer. You ready? All right, let's do it, Erik. What is one red flag every investor should look out for?
High returns on any investment property. Always do your due diligence. You can't take someone's word for it. Ultimately, it's your money. You're responsible to do your due diligence. So if someone tells you that they're going to get you a 90% return, it's probably too good to be true, and you need to do your due diligence.
Yeah, absolutely. If it sounds too good to be true, as the adage goes, it probably is.
That's right.
All right. What is a myth about this business you would like to set straight?
I think a myth is that you've got to have a lot of money to get into real estate. There's a lot of ways, a lot of creative ways to get into real estate. And do your research, get your education, because there are a lot of, you don't have to have a lot of money to make money. Now, it helps if you've got a lot of money, and you can make a lot of money if you have a lot of money. But I've met with investors, and actually just in my 7 years of doing this, I've seen people go from, hey, I'm going to rent out my basement of my apartment or whatever, and they rent it out, and then they move into single family, and then they go buy a duplex, and now they've got multiple investors, and they're going out and buying 250 units at a time. And so I've seen people grow in a short period of time. You don't have to have a ton of money to get into this business.
Yep. All right. And last question, what does success look like to you?
For me, success, when I look at success or think of success, my goal is to retire at an age where I can support my lifestyle. I don't want to retire when I'm 75. I've had parents who've retired late in life and haven't been able to enjoy all that retirement time. So my goal, success for me, is 1, having a happy, healthy family, and then 2, being able to enjoy time with that family by, again, investing in real estate is a big part of that, being able to be financially sound so that I'm not having to work when I'm 75. So that's the goal. Not there yet, still working, still here in the office. It's Friday at 5 o'clock. I'm still here at the office, but one day the goal would be to be able to have enough passive income to be able to retire at an early age.
Yeah, there you go. Work optional. I think that's the phrase I like to use, because I fear I might get bored if I literally just stop working at all.
Yes,
but
I hear you.
I don't want to have to.
Right. You want to be able to work on terms when you want to go to work, not because you need to pay bills, right?
Exactly. All right, Erik. I know this can be a complicated topic, so I appreciate you coming on to help clarify things a bit when it comes to cost segregation analysis. Please tell our listeners how they can get a hold of you and if there's anything else that you'd like to share.
Yeah, no, I appreciate the opportunity to be here. Thank you guys for tuning in. If you have any questions, we're a niche accounting firm. We don't do tax returns at our firm. This is all we do. And so if you have any questions, please use us as a resource. You can find our information at www.costsegauthority.com. We always will do a free benefit analysis. So if you've got a property you think might be a good candidate for cost seg, or if you've got a tax liability and you own real estate and you want us to look at your portfolio, we're happy to run some numbers free of charge. We're not going to charge you. We don't want to ever engage a client that's not going to save significant tax dollars. So again, don't call me and ask me about earned business income or child tax credits because I don't know anything about that stuff. But if you've got depreciation questions, I'm happy to help any way I can. So again, please use this as a resource.
All right. Thanks again, Erik. We'll have all your information in the show notes. I appreciate you coming on, and I look forward to continuing to see you do big things on your journey to multifamily millions.